You are watching Market Pulse Daily. Today is Tuesday, May 19, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. AI's big bet meets oil's price shock. What's next for your portfolio? Today's agenda: AI and tech sector watch, energy shockwaves, geopolitical tensions and defense, market sentiment and valuations, crypto's role, market update. Let's start with the engine of the current market, artificial intelligence. The AI revolution continues to be the dominant theme driving market sentiment, with Morgan Stanley setting an ambitious target for the S&P 500 at 8,300. Their base case relies heavily on continued capital expenditure in AI infrastructure and a hopeful de-escalation of tensions in the Middle East. However, beneath the surface, cracks are beginning to appear. We're seeing signs of exhaustion in AI hardware stocks, like Applied Materials, suggesting that the supply side might be feeling the strain. Furthermore, there's growing skepticism about the ability of software companies, such as Adobe and ServiceNow, to maintain their pricing power in an increasingly competitive AI landscape. The upcoming earnings report from NVIDIA is absolutely critical. It will serve as a major barometer for the health of the entire AI growth narrative. A strong showing could sustain the momentum, but any disappointment could trigger a significant reassessment of AI valuations across the board. Investors are in a delicate balancing act, weighing the transformative potential of AI against the very real risks of overvaluation and market saturation. The question remains: can the AI boom continue to defy gravity, or are we on the cusp of a major correction in the tech sector? Meanwhile, a very different kind of shock is hitting the markets: energy. We're seeing a dramatic shift in the energy markets, with forecasts suggesting oil prices could skyrocket to between about $150 and about $250 a barrel by the end of the year. This isn't just about speculation, it's driven by a significant supply shock, particularly with concerns around the Strait of Hormuz. Josh Young argues that this type of inflation, which leads to rising wages and a stronger industrial economy, is actually a net positive for the United States. This is a key distinction from past inflationary periods, as the US WTI crude is trading at about $103, lower on the day, down about 5%. Adding fuel to this fire is the massive, and often overlooked, energy demand from the burgeoning AI and data center sector, which represents a substantial future driver for oil consumption. Investors are beginning to recognize this imbalance, and the market is starting to price in higher energy costs. This could create a powerful tailwind for energy producers, especially smaller, more agile companies in the US and Canada. The narrative is shifting from a tech-dominated economy to one that's more grounded in real industrial production, with energy at its core. Keep a very close eye on geopolitical developments impacting oil supply routes and watch how inventory levels respond. This energy shock could be a defining factor for the rest of the year. Geopolitics is also playing a crucial role in market dynamics. In a surprising twist on traditional geopolitical thinking, a new argument suggests that great powers are now too intertwined to engage in all-out war. The US, for instance, faces a critical vulnerability in its defense production, heavily reliant on Chinese supply chains for essential raw materials and refining capabilities. This creates a scenario where any major conflict would likely result in mutual destruction. A concept often referred to as mutually assured destruction, but applied here to economic and industrial interdependence. Reports indicate the US possesses only a few weeks' worth of ammunition shells, highlighting a significant readiness gap. This deep interdependence is fundamentally shifting geopolitical leverage, suggesting that the current global structure prevents total conflict despite apparent tensions. The takeaway here is profound. The risk of war is mitigated not by military might, but by the economic and industrial strangulation that would inevitably follow. This forces a long-term stalemate rather than a decisive military resolution. For investors, this narrative supports a risk-on sentiment for assets like Bitcoin, as it can act as a hedge against systemic geopolitical fragility. The idea of being too interconnected to fight creates a unique form of stability, albeit a fragile one. We'll be watching for any shifts in defense supply chains and how this interdependence plays out in international trade and diplomacy. Not everyone is bullish on stocks. Some see a market peak. While many are focused on the AI boom, there's a growing chorus of concern that the US stock market may have already peaked. Peter Grandich, a seasoned investor, is taking a bold step, shorting the S&P 500 and semiconductor stocks for the first time since the 2008 financial crisis. His reasoning: extreme overvaluation, unsustainable spending on AI, and a deteriorating political and economic climate in the U.S. which he describes as the worst since 1929. He points to rising interest rates and a looming debt crisis as major catalysts for a significant market correction. The critical trigger he's watching is the 10-year Treasury yield, expecting it to break above 5%. In this environment, Grandich sees gold and silver miners as the primary beneficiaries, acting as a crucial hedge against these macroeconomic shifts. Gold is trading at about $4,540, slightly lower on the day. This divergence is key. While tech stocks are facing valuation headwinds, traditional safe assets are showing resilience. Investors should be acutely aware of the 10-year yield. A move above 5% could signal the start of a major downturn. The performance of gold and silver miners will be a key indicator of where investors are seeking safety. And what about crypto in all this? Bitcoin's role in the current market is becoming increasingly complex, presenting a bifurcated outlook for investors. On one hand, the resilience of the AI narrative and the potential for good inflation stemming from energy shocks are providing a tailwind, positioning Bitcoin as a risk-on asset. This aligns with a general risk-on sentiment that often benefits cryptocurrencies. However, the signs of exhaustion we're seeing in AI hardware stocks could mean short-term volatility for crypto if the broader tech sector experiences a correction, highlighting a continued correlation risk with equities. The geopolitical narrative of global interdependence also plays a part, supporting Bitcoin as a hedge against systemic geopolitical fragility, rather than just a direct proxy for conflict. Looking further out, the mention of potential electricity shortages and infrastructure strain could drive long-term demand for decentralized energy and compute assets, which could indirectly benefit crypto. The market sentiment is currently showing extreme fear with the Fear and Greed Index at 25, suggesting potential capitulation levels, yet we're seeing significant whale accumulation and exchange reserves hitting multi-year lows, strong bullish supply-side signals. The key for investors is to watch Bitcoin's correlation with tech stocks closely. Will it continue to move in lockstep, or will it begin to decouple and fulfill its role as a non-sovereign hedge against U.S. debt concerns and fiat debasement, much like gold? Today's live market snapshot: metals, crypto, stocks, and bonds. Now for our daily financial market update. Here is where the key asset classes stand as of today. Gold is trading at about $4,540, slightly lower on the day, and is sharply lower over the past 5 sessions. Silver is at about $76, slightly lower today, and sharply lower over the past 5 sessions. In crypto, Bitcoin is at about $76,900, slightly lower on the session, and sharply lower over the past 5 sessions. Ethereum is at about $2,150, slightly higher today. Other major crypto: Solana at about $85, flat, BNB at about $644, slightly lower, XRP at about $1.383, lower. On equities, the S&P 500 at 7,403.1, flat. The Nasdaq at 26,090.7, slightly lower. The Dow at 49,686.1, slightly higher. Internationally, the DAX at 24,307.9, higher. The Nikkei at 60,519.7, slightly lower. The FTSE at 10,323.8, higher. On the bond side, the 10-year U.S. Treasury yield is at 4.6%, slightly higher on the session, and the 30-year yield is at 5.1%, slightly higher. Elevated yields continue to place pressure on risk assets and growth valuations. Rounding out the macro picture, WTI crude at about $103 per barrel, sharply lower. The dollar index at 99.1, slightly higher. Euro-dollar at 1.164, slightly higher. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. The market is navigating a complex landscape. While AI's potential continues to drive some segments, concerns over valuation and the real-world impact of energy prices are creating significant choppiness. Investors need to watch key levels in oil, tech earnings, and geopolitical developments closely. Thank you for your attention, and we will see you again tomorrow.